Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to Standard Chartered Money Insights. My name is Marco Iachini and I'm a cross-asset strategist for Standard Chartered Bank. On this episode of the podcast, we'll discuss the view from the Fed based on the latest meeting minutes released this week, what is happening in crypto markets, and lastly, we'll have an update on mainland Chinese shares. Joining me today for this conversation, I'm glad to welcome Manpreet Gill, Head of Fixed Income, Currencies and Commodities, and DJ Cheong, our investment strategist. Without further ado, let's kick off today's podcast. Now, the latest crypto market moves have grabbed investors' attention, of course. But how does one reconcile what is happening in the crypto markets with recent moves, let's say, in traditional financial markets, and when we combine that with macro data points like job and inflation? How does all that reconcile with the Fed's plans, Manpreet?
Hi, Marco. It has been a volatile week in crypto markets, indeed. And I think the common thread here is liquidity, or at least the perception of how liquidity might evolve in the coming 6 to 12 months. But stepping back for a moment, I'd really have two takeaways from what we saw in markets in the past few days. First is just, the importance of volatility. So it's absolutely true that, crypto assets have delivered some stunning returns over the past year since the pandemic started. But at times, those stunning returns have come with almost equally stunning levels of volatility, as the last week it's demonstrated. So I think what's important is to say, the last week has really demonstrated the value of taking market views, but within the context of a relatively diversified allocation across, obviously, our traditional asset classes, as opposed to just blindly chasing the latest mania alone. Because when you start adjusting the returns you get for the volatility costs they come with, sometimes those sleepless nights, may not be worth it standalone. The second point feeds to your question, Marco, on the Fed, because to some extent, it's natural to question whether a taper is in the offing at some point, given that vaccination rates are now sort of looking increasingly sort of widespread, and we're seeing economic reopenings and of course earnings come through. It's worth noting that some lesser known central banks like the Bank of Canada, the Bank of England have started tapering in some form or shape without really hurting sentiment or risky assets. But equally, of course, the minutes from the last Fed meeting did occur before the prior jobs data, which, if you recall, did disappoint quite a bit. Plus, we have at least a couple of months of statistical base effects on inflation numbers. So we need to get through those before we can really judge whether inflation is transitory. Overall, I think from an investor's perspective, where this leaves us is that, look, we are still quite comfortable with risky assets like equity markets, because the fundamentals are clearly improving from a growth and earnings perspective, and the supportive policy backdrop does not seem to be, changing imminently. In the context of the last week itself, though, I think euro area assets are beginning to stand out because vaccinations were lagging in the euro area, of course, but those have now begun to accelerate to a rate that's now matching what the US did in its most rapid phase. And if you look at a sector like financials, which is preferred, which in our view, higher bond yields, particularly longer maturities, can help earnings through wider margins. And of course, a weaker dollar can support euro area performance, at a broader level. So that's sort of one area we'd look at, in the context of just the last week alone, within our sort of positive view on risky assets.
Thanks, Manpreet. Now, staying with the Fed a moment longer, I wanted to focus on the implications from the policy meeting minutes and perhaps reading between the lines. But what do you see are the implications for bond markets, particularly U.S. Treasury yields, but also outside of the U.S.?
Well, I think it's interesting that I think some of the comments that came through the minutes were different to what Chair Powell told us recently, that it was too early to talking about tapering. But what we got from the Fed minutes was some talking about tapering. And like I said, it's not sort of coming as a surprise when you sort of compare it some of the improvements in recent data. But equally, I think we need to balance it with, as we noted, the fact that we, since that time, we got a significant disappointment in the jobs data number. And it's still going to take us a couple of months for statistical base effects inflation to sort of run their course, and for us to really get a good feel of some of the supply chain disruptions, whether they're equally transitory or whether there's a risk that inflation could be somewhat longer lasting. Now, for bond markets, in our view, it doesn't really change our baseline view that 10-year treasury yields, stay in about the 150 to 175 range. Of course, you can have short-lived overshoots, but there is technical resistance at about 177 to 178. So, short-lived spikes, yes, but nothing of the sort we experienced when, the first sort of real surge in bond yields. So overall, of course, if we get any tapering that's sooner than expected or goes more quickly than expected, that of course could raise some upside risk. But on balance, we think that sort of view on 10-year treasury is quite consistent with our preference for US dollar denominated emerging market bonds, whether that's more broad at the EM dollar government level or of course on Asia dollar denominated bonds.
Brilliant. That's a fantastic answer. Thank you, Manpreet. Now let's move over to DJ. Macro and Fed aside, the elephant in the room here seems to be what's happening with crypto assets and the recent sell-off. What can you tell us about what has happened and what has sparked the recent sell-off, and what should investors do about it?
Hi, Marco. First and foremost, great to be back here again. I think with all the headlines around the recent crash in digital assets, we believe it will not spark a rush of liquidations in traditional financial assets. Why? The main reason here is really institutional adoption is still light, and that could help mitigate contagion fears. To understand how this line of reasoning works, we first need to look at several potential catalysts for the recent crash. Firstly, China's PBOC reiterated that digital tokens cannot be used as a form of payment. Secondly, in the US, the new Office of the Comptroller of the Currency has requested a review of digital assets and cryptocurrency policies. And lastly, the now well-known tweets from Elon Musk were also likely to blame. So putting all these factors together, we believe a backdrop of leverage across various crypto asset brokers may have added fuel to the fire, with several reports suggesting forced liquidations by both leverage and retail investors following margin calls, and that largely contributed to the drawdowns over the past few days. The slump in cryptocurrencies could possibly dent risk sentiment in the near term, benefiting gold, but we see limited risk of contagion to broader financial markets as a whole. As Manpreet alluded earlier, for investors seeking an allocation to cryptocurrencies, we believe exposure should be considered in inverse proportion to the volatility. Now, for more details on that, please see our 360 degrees perspectives publications, which will talk about the future of digital assets.
Thanks, DJ. Definitely an interesting point on volatility. It was quite gut-wrenching at some points. So it's definitely worth, as you and Manpreet have mentioned, having a look at always considering a diversified broad asset allocation and how that fits in the context of the allocation. Now, lastly, to finish with some color on equities, we noticed that below the noise that was caused by the weakness in tech and growth-related stocks, China mainland shares have actually been fairly resilient. What is your take on this area of the markets, and should investors consider allocating to China A shares?
So the answer to that question is that we believe China A shares do offer an interesting tactical opportunity, given the recent break above resistance at around 51.80, as well as the bounce from its 200-day moving average. Yes, recent price action provides some confirmation that the uptrend may have resumed, but the path higher will unlikely be a smooth one. Now, on that note, we are also seeing some stabilization in fundamentals of late. We know Chinese onshore equities have been pricing in policy tightening risks, as well as a peak in the domestic economic cycle. So a lot of these factors may already be in the price, in our view. In short, China will likely avoid over-tightening as its policy continues to emphasize stability, and that means limiting monetary and fiscal excesses. Now, long story short, Chinese equities remain a core holding, meaning we expect them to perform in line with Asia ex-Japan equities. And within China, we maintain our preference for Chinese onshore equities given their heavier weights to value-oriented stocks. In short, the rotation from growth to value sectors remains very much in play.
Thanks, DJ, and thanks again, Manpreet, for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thanks for joining us, and goodbye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.